Hi everybody, this is Gary Dean with Sentiment Timing, and this is our free weekly video report for Wednesday, November 8th, 2017. I hope all your trades have been going well, and let's get started because we have a lot to go over. So we have what we've been looking for, actually what was taking place back in the August timeframe was we were looking for a larger drop, and we got two decent sized drops right in our towards Woody's turn dates, but it found a low, and once the S&P went above 2480, that was a stop. So there was no, we every once in a while we get these emails from how wrong we were, but we got two 50-point drops. They didn't go the 100 points that we were expecting on it, but it was still two decent trades that ended up being stopped out at 2480. So it wasn't, like we were short. And that's one of the important things that we try to relay to everybody is that, yeah, it was the call was partially right. It was, they took place right when they were supposed to. But we have to understand when something isn't going as planned, and you have to have your plan B and where your stop is in place, and ours was 2480. So yeah, the overall game plan didn't work out as expected, but the stop was in place, and that's it. So the reason why I've been very cautious about this rally since those lows is that we are in a couple of wave fives of fives, which I will show you in this video. But when you're in these wave fives, I like to think of it as thin ice, where yeah, you can be skating around and everything seems good, but as the weather warms up, that ice is getting thinner and thinner, and you don't know when it's going to drop. But once these wave fives complete, there is going to be some volatility in this market, and we have some upcoming dates that we're going to, that we're watching, and it should be some interesting times. So the whole thing is that we have sentiment also, where you're seeing it on the financial news, you're seeing it on just about every newsletter, and nobody really believes that this market will ever go down. They think the central banks are behind everything, and but sentiment is sentiment, and we're gonna get moves within larger moves, but and that's really what we're concentrating on. We don't really care about the bigger picture. Yes, we'll look at it, but we're looking at the moves that are going to get us 40, 50 points on the S&P, and almost always you are going to get your drops when everybody's euphoric on the market and nobody thinks it's going to go down, and once everybody starts panicking and capitulating, that's when you're looking to buy, because that's when a low is going to be in. And that is how institutions really trade this market, is once it gets into the thrill, they're unloading their long positions and they're starting to build short positions, and they don't try to be exactly right on the top, but they know as it goes down, and once it gets into the panic, guess what they're doing? They're covering their short positions and they're starting to build long positions. And that's just a cycle that repeats over and over. So if we take a look at what's going on with sentiment, I mean, you could see people have been in these sentiments right here, even though they're high, doesn't, and that's something that's really good. I want to just touch on this, that having someone like Woody Dorsey able to diagnose this, because the high sentiment doesn't mean that we have to head down. Sometimes it's actually a confirmation of a breakout. And you can see once we got above some levels and we had the high sentiment, it started going. But once everybody started getting bullish on the market, now it throws up the warning signs. And you can see we have a very big bearish divergence with sentiment and price. And there's also a lot of other things that are not confirming where we are right now. And like I said, when you match that in with where we are as far as a wave structure, now is not the time to be complacent. And I know a lot of people are just like, oh, don't worry, once it drops, I'll get out. It's not going to be that easy, because if you think about every single drop that we've had so far, whether it be 5 points, 10 points, or 20, they've been bid back up. So people become hypnotized by that the market's just always going to get bid back up. So when it has that drop, what do? They've been conditioned to buy the dip. That is when all of a sudden, when it continues to go down, what is human nature going to do? It's going to tell you to average down again, because the market has conditioned you to, believe that the dip is going to be bid back up, and it's been bid back up. So that's not wrong, but it's when it changes, and why so many people get caught on the wrong side is because they, like I said, they get conditioned with one way, and the market doesn't make it easy. So when it drops and they buy, and then it drops more, they buy more, and then what happens? Guess what? We start going into the panic mode, and then they start unloading all those positions that they were buying all the way here, and that's when institutions start buying. So we have a massive divergence with sentiment, as we've had short-term extreme bullish sentiment levels. Now, on top of that, notice that we have institutions that have been selling these rallies, and this is today. There was the money flow was pretty negative on it. The spiders was in the number one spot as far as selling the rallies. But here are some of the things that I've really been concentrating on, and this is the advanced decline line, and this is the red, is the advanced decline. But whenever we had these minor little divergences, if you've noticed, they've caused pullbacks, and we actually have one going right now. So this is a red flag. And again, this is not the market has to go down tomorrow. It is a red flag saying that the price is not being confirmed by the advanced decline line. Now let's take a look at a few other ones. These are stocks that are above the 50-day moving average. This is on the Dow. Dow's making new highs. The stocks above the 50-day moving average is not even close to that. So that's diverging, and it's telling you that just a handful of stocks are lifting the Dow. Nasdaq, massive divergence here. We see more and more stocks below the 50-day moving average as the Nasdaq is moving up, and we've seen that before. And typically, what it means is a sharp decline follows not too far after. And if we take a look at the S&P, we have the same thing, massive divergences. So these aren't that the market has to go down now, they're red flags, and that's a major thing that you want to keep an eye on, because even though all the kids are skating around the pond, the ice is thin, and you don't know when it's going to break. Here is the McClellan summation index. This cross right here, every time we've seen the S&P drop anywhere between 50 and 100 points. That's been the minimum. We have not even come close to that. So that this cross right here, the move hasn't even started. So that's just another reason why you really want to be cautious. So if we take a look at our regular charts here, this is what I'm talking about with the wave structure, where you have 1, 2, now you have your 1, 2, a very extended wave 3, 4, 5. So here's our 3 on that. Here was our wave 4, and now we're in this last wave of the last wave of this wave 5. Now, once this completes, it means that this move is done, and we're going to get a retracement. Doesn't mean we have to turn into a bear market. Absolutely not. Now, something else I would talked about was the bearish wolf wave, and that's this pattern right here. It's a bearish wedge, but here's the target, and the target's coming all the way down to somewhere near this 25.54. Now, the reason why I think this is important is because one of the things I've been telling members for, which seems like forever, is that this wave 5 can extend until we see the S&P drop below the 50-day moving average on the hourly chart. And what happens when we know this is going to be complete is it drops below, and then it's used as resistance. And when that happens, that's when I will stamp this wave 5 done. And the reason why that's important is once that's done, this wave 5 of 3 is done, and this is the expected wave 4 that could come anywhere down to the 24.10 all the way down to the 22.94 or even lower. But does it mean we're in a bear market? No, it just means that this is our wave 4, and our wave 5 is probably going to take us up to new highs. But if we're in this type of move here, nobody's going to be looking at a wave 5 up, because everyone's going to be panicking because they were buying the dip down here, and the S&P could be, some 200 or 300 points below that level. And as we know, we really haven't even seen that kind of drop in many years. So it's it's something where, even though I'm expecting this pullback based on the the wave structure, it doesn't mean it's a new bear market. It's going to be a buying opportunity, but we have to see where things are and where sentiment is as we approach the support levels. But first off, we have to see when this actually completes, and that's going to complete when this wave 5 is done. So the main thing that I would really take right now is just don't be complacent. We have some turn dates that are coming up. We already know that we have sentiment that is at extremes. We also have a bunch of the internals that are diverging. So most likely we were looking for chop into our turn date. We've been getting that. Once it comes, I wouldn't be surprised, to see some volatility pick up, and there's probably going to be some money to be made. So with that, let's see what plays out. Until next week, we have a special going right now. If you guys are interested in finding out when the turn date is, join now and have a great night.